Corporate finance practice problem using OneNote. Bond refunding decision problem number 2. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're down in the 1628 Bond Refunding Decision Problem Number 2 tab. Also note, when using OneNote, take a look at the immersive reader. Many of our presentations will be in the text area as well. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Close in the icon. We have our information up top, calculations then on down below. We're looking at the bond refunding decision. So we currently have the bond outstanding, $40 million. The issue rate at the 13%. The current rate is 12%. So the question now, we already issued these bonds at the 40. We're paying the 13%. The refunding decision you could think about as, in essence, a refinancing decision, right? We're going to try to see if we can refund the bond and have a lower rate so that we can then be paying less interest. But we need to take into consideration all the other components of that process, including the cost of doing so. So let's go through the rest of the components. We have the original issued years ago, 8 years ago, is when we originally issued the $40 million worth of bonds. Remaining years is 18. So in other words, we're going to say that 26 years ago, we issued these. We issued these 8 years ago for the $40 million, and we had a life of 26 years. 8 of those years have now passed, so we have a remaining life of the 18. Now we're thinking about calling those back and issuing new bonds for the 40 at the 18 years. So we'll be matching the years that will be remaining. Basically, you can think about refinancing or refunding the still remaining portion of the debt term. So we can call them, we're going to call them back on the old bonds. To call them back, it's going to cost us 5%, but with a little bit of a twist. That's going to start in year 6, so we have to wait till after the year 6 to do that. And then we're saying it goes down each year by 0.5%. So in other words, 0.05 minus the 0.005 minus 0.005. I think I did that right. It's 0.04 because we're talking 2 years after that 6-year time period. So a little bit of twist on the call rate. Then we have the underwriting cost on the new issue are going to be a percent of the bond value. So that's all we're saying there is that 0.035 times the bonds, which were the 40 million. So times the 40 million, it's going to cost the 1.4 million to float these things or get them out on the marketplace. And then the old bonds, the underwriting costs were 2.7. So 40 million times the 0.027, that was the 1.080 million for the cost of us to float or get out on the marketplace the last bonds for the first go round. Now these two are going to be important because they're going to have this one will have a cash flow up front, the cost of us issuing the new bonds, but it's also going to have a tax impact that we're going to say that we have to allocate over the life of the bonds. This one is a cash flow item that happened where it's saying that amount actually went out when we issued the original bonds, but the tax impact hasn't been fully reached due to the fact that we had to basically take the expense, kind of like depreciation, over the life of the bonds. That's why it's going to be a relevant factor here. The original cash outflow is a sunk cost at this point in time. Doesn't really factor into the current decision-making process, but the tax impact is a current decision-making thing, does impact the current decision. Tax bracket 35%, discount rate at the 11%. Let's calculate first the net cost of the call premium. Net cost of the call premium. So we're going to say that the bond obligation is going to be the 40 million. We had the call premium that you'll recall we calculated at the 5%. And then we subtracted out the 0.5 times 2 because it was 2 years after this year 6, because this is happening 8 years out. So that's in essence going to be the 4%. So the 40 million times the 4%. Now notice when we call these back, of course, we're going to have to meet the debt obligation of the 40 million, and then we're going to issue the new bonds to kind of refinance, to refinance it. The thing that's going to differ, and that's what we're focusing in on here, the things that are different between the two transactions, because those are the relevant factors as to whether it's going to be a good decision or not when we compare two things, two courses of actions. what will be the differences between those two actions, or what we're looking for. The call price is going to be one of the differences. So we're going to take the 40 million times the 4%. So we got the 40 million times 0.04, 1,000,006. So we're looking 1,600,000. And then there's a tax impact. So that's going to be 1 minus the 35%, or in other words, the 65%. So in other words, we have to pay this amount, but of course we get some of it back with regards to the taxes, because it's going to have an impact on the taxes. Also note that the 35% we might be considering like the marginal or last tax bracket, because every decision we make is basically at the end, at the margin here generally. That's a general idea. So we'll take the 1,000,006 and we'll multiply that times the 0.65, and that's going to give us the 1,040,000. 1,040,000. Next, we're going to take a look at the underwriting costs and tax impact. Underwriting costs was the 1,400,000, and you'll recall we calculated that by taking the 40 million times, and then we said down here that it was 3.5%. So times the 0.035 to get the 1,400,000. The 1,400,000. Then we have the issue years, so 18. So we're going to have the 18 years because these new costs that we have, this is going to be an outflow, the 1,400,000. That's going to be a cash component in and of itself that we're going to have to pay. We're going to assume they pay up front if we decide to issue the new bonds. But from the tax component, we have to, kind of like depreciation, we're assuming we have to expense it over the life of the bonds, which we say are 18 years. We're going to issue these bonds for the remaining life that we're on the old bonds, basically refinancing or refunding the old bonds. So we're taking it over the 18 years. So the 1,400,000 divided by the 18 years gives us the 77,777 that we get to basically deduct as kind of like an expense for 18 years, which would add up to the 1,004,000. But so we don't get that deduction all at once. And then we're going to have a tax impact on that each year at the 35%, we're assuming, our tax rate up here given the tax bracket. So if we multiply that times 0.35, we get about 27,222. And that's going to be then the tax impact that will be in effect for those years, the 18 years that this will then be covering. So now we want to present value that 27,222, which is kind of a tax benefit. So in other words, cash outflow of the 1,400,000. There is a tax deduction for it, which, like the thing up top that we calculated up here, will have a tax benefit. But unlike this item up top, we don't get to expense it up front, but kind of like depreciation, have to then take the expense over the life, which would be 18 years. That's what we are assuming. So therefore, we calculated the tax benefit per year. And then because it's going to be happening for 18 years, we got to consider time value of money. So now we're going to apply our present value type of calculation to get to the present value of the tax savings. Looking something like this, it would be the present value of the rate, which would be the 11%, and then comma, number of periods, which would be 18, and then comma, the payment would be the 27,222. That gives us the present value of the 209,655 about. So the present value then of the outflows is the 1,040,000, which we calculated up top, the 1,040,000. Then we have the underwriting costs for the new issuance to issue the new bonds. We're saying that's going to cost us 1,400,000. That's simply all the cash outflow. Then this is going to have a tax benefit for us of the 209,655, which we had to calculate separately due to the fact that we're going to have to extend that over the life of 18 years. So let's go ahead and add these up then, just for the fun of it. We'll do it in the calculator. 1,040,000 plus 1,400,000 minus 209,655, and that's going to give us the 2,230,345. So there we have that. Then we want to calculate the net annual interest savings. So in other words, we had the initial interest at the 13, the current interest rate at the 12, the difference is 1%. That's why we're doing this most likely. We said, hey, look, we issued these 40 billion at the 13%. The current rate looks like 12%. Maybe we can refinance these or refund them. Same kind of concept and then get a benefit. What's the difference? Well, it's 1%. Does that 1% savings account for and surpass the cost of us doing this process, right? So we got that 1% difference, and we're focusing in on the differences because the differences are what's going to impact whether or not we do the decision-making process. Those are the relevant components. So the 40 million times the 1% would be the 400,000. That's the net annual interest savings. So we're going to save on the actual cost, like the rent on the money, the rent on the loan, the rent on the bonds, the interest of 400,000 per year. So then there's going to be a tax impact, which once again is going to be 1 minus the 35%. So 1 minus the 35% for the tax impact. And that's going to give us the 260,000. So the 400,000 times the 65% gives us the net annual interest savings of 260,000. That's per year. So then we're going to do our present value type of calculation once again. So the negative present value, the rate is going to be the 11%. Number of periods will once again be the 18 up top. And then the payment now is going to be the 260,000. That's going to give us the 2 million, the present value of the interest savings, 2,002,420. So then we're going to take a look at the annual amortization of the old bonds. So the old bonds. So now this one is kind of the tricky one. You'd think, well, why does that matter? Because you'll recall that we had the old issuance, this 40 billion that we issued before, was the 40 billion times, it cost us 2.7, so times the 0.027, it cost us the 1,080,000 in order to issue them. So you might think at first, and this would be correct, you say, well, hey, that's a sunk cost. It doesn't really impact this decision. That happened in the past. It's already done and gone. Why are we thinking about it now? We're thinking about it now because of the tax impact. The tax impact is not sunk because these costs, you'll recall, we're assuming we have to then allocate them kind of like depreciation over the life of the bonds. So we're going to take that 1,080,000 of the old issuance, divide it by 26, which is the 8 plus the 18, the complete years, total years that we had issued them for 8 years ago at the point in time that we were going to issue them, so that we can calculate the straight line expense per year, the per year expense, kind of like a straight line depreciation calculation. So we would then get to expense the 41,538. Now 8 years had passed, so you could say, okay, well, if I take the 41, let's say 41,538 times the 8 years, we would have then expense 332,304 of the cost of 1,080,000. So if I subtract this minus the 108,000, we have not yet expensed the 747,696. Or in other words, you can take then the 41,538, which has 18 years that have not yet been used up. In other words, we had 26 years minus 8 years have passed, 18 years left, times the yearly rate, times the 41,538, gives you once again the 747,684 about. There's rounding involved here. So that then would be the unamortized cost. We're talking the unamortized cost. And so if we were to expire the bonds now or retire the bonds at this point in time, then we would no longer have to amortize them over the 18 years. You would think that we get to deduct the rest of it now because the bonds that they're related to will then have been, taken, they would have been matured. We would have matured them and paid them off. In other words, we would have, called them. Or if we don't call them, then we'll have to take that same amount over the 18 years, 41,538 about over that year, that time period. So the difference between those two methods will be a factor in our decision-making process. You might think there is no difference because the dollar amount will be the same, but there's time value of money if we were to think about this one taking the deduction over 18 years versus this one where we get the deduction up front. So we'll take the present value then, the present value of the rate, which is going to be the 11%, and the number of periods, which is 18, and the payment we're looking at is this 41,538. So again, if I was to take that 41,538 times the 18, I would get to this 747,692 about. But if I take that 41,538 and I present value, I present value the annuity, I'm going to get to something less, and that's going to be the 319,913. So if I was to retire the bonds, then I'd get the full deduction now, which would be equivalent to the current amount that we have not yet amortized. If I was not to retire the bonds, then I would still get that amount of expense in total dollars, but it would have to allocate them. And if we present value that at the 11%, it would be the 319,913. So let's take a look at what that difference means. So the unamortized cost that we would get to take if we made the decisions to retire the bonds and refund the debt would be the $747,692 versus the present value of the unamortized cost if we decided not to make the decision and just simply keep going forward and deducting the $41,538 on the old issuance. The difference between that would be the $427,779, and then we're going to apply the tax savings for that, or the tax rate to that, which is going to be the 35%. So the $427,779 times the 35% would give us the cost tax savings, which would be the $149,723. So the $149,723. Notice this whole step has to do with not the cash flow of the process, but with the tax impact that is resulting from it. So then we can look at the present value of the cash inflows, which we're going to say are the present value of the interest savings, which we calculated at the $2,204,420. So there we have that. And then we have the cost tax savings, which we just did, the $149,723. About adding those up, we get the $2,152,143. So the net present value calculation, then we got the present value of the cash outflows, the negative $2,233,345, which we did up top right here, $2,230,345, and then we have the present value of the cash inflows, which is the positive number, $2,152,143. About, there's rounding involved here. Adding those up, we get a negative $78,202. Now, this being a present value type calculation, due to the fact that it is negative, it's most likely the case that we would not want to move forward with the decision, given the fact that we didn't clear the hurdle rate or the discount rate, cost capital, the 11%.